Well, good afternoon, everyone. I just want to firstly welcome you to our first quarterly update of the new calendar year on superannuation. Now it's been on 12. Given that we have a fair bit of material to cover off, because surprise, surprise, there's been a few changes in super of late, we will get cracking. So, what's been going on? I suppose firstly, just the general advice warning. It says you can believe what I say, but you can't actually believe it unless you talk to me specifically about your requirements. Now, firstly, what are we going to cover off? Well, we're going to have a look at the federal budget from last year and what's actually happened, or more to the point, still hasn't happened in relation to the changes that were proposed in that budget. There's been a fair bit of movement in relation to when a pension starts and stops on a few different fronts and a few different angles. So we'll talk about that. There's been a bit of talk about the changes to the supervisory levy. So we'll cover that off. Just a general reminder about the ATO's updated their website for the current thresholds and updates. Other just bits of random bits and pieces that we'll talk about. So I'll just talk about quickly rollovers, trauma insurance, and more generally lost superannuation and some changes that have happened with that. Interest-free loans in relation to limited recourse borrowing arrangements. There's been some discussions at the National Tax Liaison Group in relation to those matters, so I'll cover that off. I'll just briefly mention a couple of ATO prosecutions that have been occurring. And then finally, as you're probably all aware, on Friday the federal government announced some proposed changes to superannuation, essentially to try and cut off some of the speculation that was kicking around as to what was going to be in the budget. So I will very briefly cover off on those depending if I have time. Look, I haven't gone into the normal compliance and generally AAT cases that I usually do, for the simple fact that there's a fair bit of material already here, and essentially I could spend an hour just on the proposed changes. So anyway, we will get going. So as far as the budget progress goes from last year, now firstly a recommendation that occurred way back in 2010, for those of you that can remember the Cooper Review into the stronger superannuation, from the SMS to value their assets at market value, that regulation has now passed. I'll talk about on that a little bit. ATO administrative penalties, that bill has been introduced, and that's the bill there, the Superannuation Legislation Amendment Reducing Illegal Act Early Release to Other Measures Bill 2012. Certainly a mouthful. They don't make these things simple. And then finally, the banning of off-market transfers. That bill has also been introduced. Now, I suppose I'm emphasising the fact that some of these bills are only being introduced. They haven't actually been passed as yet. Between now and 30 June, there is, I think, 3 weeks of sitting days for these bills to get passed, bearing in mind that we have a budget in there as well that will obviously also have a fair bit of material in it. And then basically, I don't believe I can't recall of any further sitting days until Parliament is dissolved because of the federal election on 14 September. So really, we have 3 weeks to get these 2 bits of bills through, plus lots and lots of others that are still kicking around just generally. So the ATO directions and administrative penalties, as I mentioned, this is in the Superannuation Legislative Amendment Bill. It was introduced in November 2009, but has not yet received royal assent. The bill provides that the regulator will have the ability to issue a rectification direction and or a education direction. And also, well, essentially where it believes that a trustee has essentially contravened CES. Now this is effective from 1 July 2013. Well, at least that's the proposed start date for these measurements, or these measures. Now, to cover off on what the administrative penalties mean, I've got some information here that you can see that does talk about it does go through it all in a fair bit of detail. So I will provide these as part of the slides that we hand out essentially at the end of the presentation, or we email out at the end of the presentation. But basically, the rectification direction is where the ATO can now tell the trustee how to fix things. Previously, they haven't been able to. The trustee is the one who has actually had to advise on how things are fixed. So now the ATO will be able to tell how things are fixed. An education direction. Basically, an education direction is where the ATO want the trustees to become better educated about what they're doing. So in other words, they will see a breach and they will say, okay, we want you to get better educated to actually understand what you're doing. And then finally, we have the administrative penalties. Now, these things are very important. Essentially, they're like speeding fines. They're automatic, and some of them can be very expensive. For example, not lending to members, $10,200 per trustee, and every trustee is jointly and severally liable. So what that means is that even if only one trustee is part of the breach, everyone gets involved. And also, these penalties must be paid personally, so they cannot be paid out of the superannuation fund assets. So if you have a situation where you do a breach and then it's not rectified, for argument's sake, for another 3 years, so it continues to be a breach, then that's potentially 4 years of problems. So firstly, when it happens, and then every financial year thereafter, that you can be liable for one of those penalties. So potentially for 4 years, or for 4 offences, that's $40,000 of personal fines that the trustees have to cough up, and that's each and every one, whether they're individual trustees or directors of the corporate trustee. And it's all based on penalty units, and it's $170 per penalty unit. Now, we did cover off essentially on this last time we had a webinar, but that was before the bill was actually introduced into Parliament, so there's another section that's sort of crept in there. So what you'll receive is the most up-to-date information in that regard. Off-market transfers. Now, for those of you who can remember or can be bothered to remember, there was a couple of years ago they proposed to ban off-market transfers essentially before 30 June 2012. They then extended that to 30 June 2013. Well, actually, what they've done in the bill that's been introduced, once again, it hasn't yet been passed. It went to a joint Senate Select Committee, which on the 19th of March recommended that it is passed. And the Schedule 4, sorry, is the relevant part to that bill, because it's quite a lengthy bill. But what they've actually done is they haven't limited it to shares. They've more generally spoken about related party transactions. So self-managed super funds and related parties, and these measures are specifically for self-managed superannuation funds. So previously we had a blanket where it was in relation to all superannuation funds. These are specifically for self-managed super. So what they've done is basically introduce a couple of new sections in section 66, which is the related party sections. So now they've introduced section 66A, which prohibits the acquisition from related parties. Now, some of you may be saying, well, hang on, isn't that already there? Well, yes and no, it is, but one big difference is that they have removed the word intentionally. So you can no longer, so the trustee or the investment advisor can no longer say that they didn't undertake this transaction intentionally. There's no intentional requirements. It's now you just cannot do it. So you have to look through all the veils, all the corporate structures, and what have you, to make sure that there is no related party issue there. Two exceptions, which are essentially the same ones we currently have, which are listed securities acquired in a way as prescribed by the regulations. Now, I love this because they haven't released the regulations, so we don't know what that actually means as far as the detail goes of yet. Now, there's talk that they will allow what's technically called crossing. So that's where a broker can do a buy and sell without it actually hitting the market. Excuse me. But that will mean a change to the Corporations Act, because brokers aren't actually allowed to do crossings. So there's still more to play out on this one. Business real property, once again, that's still, the carve-out essentially still exists. However, they've now said that it needs to be acquired at market value as determined by a qualified independent valuer. Section 66B of SIS, you are now prohibited to dispose of assets to related parties, and this includes in-specie transactions. So once again, you not unlike the acquisitions, we now have disposals. Previously, you could sell anything to anyone, but now from 1 July 2013, you will no longer be able to sell the unit that you've purchased that you want to retire in. This transaction will no longer apply because it is not as part of the general requirements unless it comes under one of the exceptions. So the exceptions here are, once again, listed securities by way of the regs, and once again, what regs? Collectible and personal use assets. Now this has its own regulations in relation to selling to related parties, and there's also a general exception there as to the transaction has to be done at market value. So previously, you could sell assets that weren't at market value to a related party, although you'd likely come full foul of Section 109, which is the arm's length test. And once again, that market value needs to be determined by a qualified independent valuer. Now, essentially, independent qualified valuer is someone who has the necessary skills and experience to value that asset. But there's a whole definition that's basically built into the Act now. And finally, oh no, I shouldn't say finally, they've also introduced Section 66C, which is essentially just an anti-pavoidance provision for schemes. So you can't enter into a scheme or arrangement that is designed to circumnavigate the related party acquisition or disposal rules. One thing that's rather interesting is that they've also changed where the business real property definition lives inside the SIS Act, and they have also broadened or put more detail, if you like, in relation to what actually constitutes a business real assets. So the definition now will sit in Section 21 of SIS once this is all passed, essentially, like I said, it's more defined, but it's still consistent with the SMSFR ruling 2009/1, which talks about business real property. So currently, the business real property definition sits within Section 66(5), so that will no longer apply to self-managed super funds. Okay, now as I mentioned, there's been a fair bit of discussion about pensions starting and stopping. Now you may remember that the Tax Office a little while ago issued TR 2011 D3, which is the draft ruling on essentially when a pension starts and stops. Now this ruling is effective from 1 July 2007, because that's when we had the new legislation for Simple Super. And basically, that ruling says that a pension ceases on death of a member. So full stop, if you die, that's it. Unless, of course, you have a reversionary pension, or you have this wonderful mystical thing called an automatic the reversionary pension should be an automatic reversionary pension, which, once again, reversionary pension is not defined in SIS or is automatic for that matter. And the other time that you will essentially bypass this is if you have a binding death benefit nomination where the beneficiary is nominated and the form of payment is specified on the binding death benefit nomination. So it actually needs to specify that the binding death benefit nomination is to spouse X, and that is to be paid in the form of a pension. That's to avoid basically the guidelines under TR 2011 D3 as to when a pension stops on death. That ruling also talks about if a minimum pension wasn't taken, and basically it said that if it's not taken, then bad luck, you lose the tax-exempt status of that pension, of those pension assets for the whole year. So basically it means that you drop out of pension phase, the components reset potentially depending on when all this happens. Well, what I was talking about, the pension would stop, say, effective 1 July 2011 if they didn't make their minimum 2012 pension payments. And then when you restart the pension on either 1 June 2012 or 1 July 2012, being the earliest two dates that could occur, then obviously your components are then recalculated based on your the earnings of the fund and your taxed and untaxed elements. Any payments that may have actually been made during that financial year, so let's say that you had a minimum pension of $50,000, but you only took $10,000. That $10,000 is essentially treated as a lump sum, and you do not get the benefit of the exempt current pension income, so the tax deduction that you currently receive for having a pension in the fund. That is no longer available. Now, in practice, if you receive some payments, at least you have the opportunity to calculate when the pension technically stopped based on the amount of payments that were made, or the dollar amounts of the payments were made, and you could say the pension stopped on that date, and then you'd have to restart it, as I say, from 1 June or 1 July, so the following financial year. So that's how that tax ruling reads. However, as is always the case, the tax office not necessarily changed their mind, but they expanded on the ruling, but not within the ruling, but somewhere different. They've actually come out and announced that they will use their general administrative powers to ignore an underpayment. But they will only do this if the underpayment is due to an honest mistake, resulting in a small underpayment, or the payment or the shortfall was essentially outside of the trustee's control. This will then mean that they're entitled to the exempt current pension income deduction once the payment's made. The catch-up payment has to be made within 28 days of the shortfall being discovered, and essentially it's treated as if the payment happened in the prior year. So it's put into your sundry debtors. And basically what that will mean is that the pension continues as if that minimum pension was actually made during that year. So so now the detail is, how does all this actually work? Well, you can self-assess, which is great, so long as it's the first time for that trustee, it's only a small payment, and the tax office have deemed a small being 1/12 of the total minimum pension amount. And if you don't meet those two criteria, then you have to go and write to the tax office. So essentially what they've done is they've introduced a de minimis amount in here, being 1/12 of the minimum pension. So that de minimis amount means that you pay it within 28 days, and then the pension essentially keeps on going. So look, I think it is a really practical outcome from the tax office, and it's great to see that they've trying to to work with trustees and the industry to come up with what is really a practical and fair solution. I suppose where this comes unstuck is for those trustees that only pay pensions once a year. So for argument's sake, if you set up a direct debit on the 30th of June to pay your minimum pension, and lo and behold 30 June this year is on Sunday, then that won't get processed until the 1st of July. Then you have not met your minimum pensions, and you cannot use this GAP provision that the tax office are offering. You'd actually have to write to them and say, hey, can we do it, blah, blah, blah. And given the fact that you could potentially argue it's outside your control, they may allow it. But in talking to Stuart Forsyth, the Assistant Commissioner for Taxation, he would basically say, well, look, you should have known that that was going to happen, so bad luck. So certainly something to watch out for on that one. Now, and also, which flies in the face of the TR 2011 D3, is back in October last year, Bill Shorten, the Minister for Super, announced that he would change the regulations to that would essentially mean that a death of a pensioner does not have capital gains tax implications for that member. The regulations have been introduced. At the moment they're still draft. Submissions closed on the 14th of Feb, but yet we still haven't seen a bill hit Parliament once again. Hopefully we will see that before 30 June, fingers crossed. But basically this means that a pension will continue after death for tax purposes. So it doesn't mean the minimum pensions have to be made, it just means that for tax purposes to receive the exempt current pension income deduction that these measures will kick in. Now, so essentially until a lump sum payment is made or another pension starts to a spouse, the pension for tax purposes is considered to be continuing, provided the payment is as soon as practical after death. Now, your guess is as good as mine as to what exactly as soon as practical after death really means. So there's still some water to go under this bridge and some lovely interpretive decisions to be made, I'm sure. Also of note is that this bill is only, or this regulation is only meant to come in from the 2013 financial year onwards. So there's a big void between, technically, 1 July 2007 and 30 June 2012. So then in those situations you need to revert back to the tax ruling, or the draft tax ruling essentially, and the pension would essentially cease. Now, because this isn't legislation, I wouldn't be hanging my hat on the fact that it's going to pass by 30 June. So to provide certainty to clients, I would certainly recommend either reversionary pension or putting a binding death benefit nomination in there that states that the pension will, that the payment is to be made in the form of a pension. Once the bill's passed, then at least you can avoid the nasty situation of a member dying and then the trustees selling a nice big asset so they can pay out the death benefit and incur a very large capital gains tax bill. So at least that will provide some clarity there. Moving on, the supervisory levy. Now, there's basically they've proposed that the levy for self-managed super funds, or the maximum levy, increases from $200 up to $300. So the way it works at the moment is that the legislation says that the ATO can determine via regulations how much they want the levy to be, anything up to $200. Lo and behold, we have $200 right now. Funny that. This bill basically changes that up to $300. But once again, the actual levy amount is still to be prescribed in the regs. Now, this bill also means that they're changing the way in which the income year is levied, so the collection of the levy. So from 2014 financial year, there'll be a phase-in. So what this basically means is that the levy for a self-managed super fund in the financial year ending 30 June 2014 will actually be $321, and then following year $388. That's basically the catch-ups, and then we flop back to what is going to be, or is prescribed as, the new levy of $259. So that's sort of where that's at the moment. Now, it's still to be collected via the tax return, so it'll work exactly the same way as what it does now. So once again, more costs to running a self-managed fund. Essentially, the biggest comments that have come from, because this bill went to a Senate Select Committee, like a lot of things in super have been doing of late, and the feedback from industry in that is, look, we don't necessarily have a problem, but we'd like to know what the increase is all about. You know, remembering that only a couple of years ago, the levy was $45. Now we're up to, well, potentially on an ongoing basis $259. So in anyone's eyes, that's a very big rise, and that rise should only be relating to the compliance aspects of self-managed super funds, not to help fund the processing of tax returns inside the tax office. So there's still some clarity to be provided in relation to the justification for that increase. But expect it, because it will happen. I just wanted to briefly mention the ATO has updated their website, that's the web address there, for their key superannuation rates and thresholds. So essentially the concessional cap, contributions cap of $25,150 for non-concessionals remains unchanged for the 2014 financial year. These caps haven't been indexed, as the index was frozen in the budget basically up until 1 July 2014. After that, then we expect normal indexation to apply. So in theory, from the 2015 financial year, the cap should be $30,000. And I'll touch a little bit more about this when I talk about the proposed measures, because it all sort of changes again. Also, for those rates and thresholds, the CGT cap amount is now 1.315 for the 14 year, and the CGT cap amount for non-concessionals is the same, and the lump sum rate threshold is now up to $180,000. Just want to briefly mention about rollovers. From 1 July 2013, so a couple of months away, rollovers for SMSFs will be captured under the anti-money laundering schemes, which means that more obligations and ID verifications will be required. Now I wanted to mention this because we're already starting to see some of this from the public sector super funds, where they're actually now requiring 100 points of ID rather than just a driver's license. So just something to be aware of there. I just want to mention about trauma insurance. From 1 July 2014, there's been a change where self-managed super funds will now, any superannuation funds, will no longer be able to offer trauma insurance. If you already had trauma insurance in place before 1 July 14, then the fund can continue that or provide that cover, but no new policy can be taken out after 1 July 2014 for trauma. Also of note is that trauma insurance is not tax deductible, and furthermore accessibility of trauma insurance is a huge issue, because just because you have a heart attack doesn't necessarily mean that you meet a condition of release and you can access those insurance monies. So just because the insurance company pays out doesn't mean the trustees of the super fund have to pay out or should pay out. So I have never been an advocate of having trauma insurance inside super for that very reason. Just a little bit of change to Lost Super. Basically, back as part of the mid-year economic update, the government proposed a change effective from 31 December 2012, that any account balance threshold under $2,000 or any uncontactable member with a balance under $2,000 will be those account balances will be transferred to the tax office. Now the tax office, so essentially the tax office is going to look after it for them, and they will pay interest at CPI until they can basically repatriate that person via via the tax file numbers. So basically within Australia, I think we have about 28 million superannuation accounts, and we only have about I think it's 14 million workers. So what that really means is there are a few people that have multiple accounts, but also there are seasonal workers, particularly backpackers, that have superannuation accounts because the employer was obligated to pay, that they've left the country not realising they've actually got a small entitlement here. So now the tax office will look after that money for them on the guise of protecting it from fees and other measures, so that if and when they ever want to claim it, it's there and ready for them to claim. More importantly, this really gives gives Treasury some more cash to flow around for their cash flow. So it doesn't mean that whoever goes overseas, or whoever the lost super account belongs to, doesn't mean they've lost it. It just means that they actually have to then try and find it. Now, if they're an Australian resident and lodge a tax return, that shouldn't be a problem, because the tax office will do that via the Big Brother tax file number data matching approach. But it's more importantly about those seasonal workers that will essentially lose their super because they don't even know they have it. Also of note is that the period of inactivity will reduce from 5 years down to 12 months. So if you have a superannuation account that you do not put money in for 12 months, then the tax office in theory can claim it. Also remembering too that there is an automatic, coming in is an automatic consolidation of superannuation for people who have multiple superannuation funds. However, this isn't meant to apply to those that have life insurance and things like that. So that's still 12 months or more away, but that is in the pipeline, that there will be an automatic consolidation. Bearing in mind that self-managed super funds will be actually exempt from those rules. Now I just wanted to briefly talk about the National Tax Liaison Group. Now this is essentially a group of tax practitioners, superannuation practitioners, the tax office, ASIC, APRA, anyone you can think of that may have a vested interest in something relating to tax or super, that meet sort of every quarter. And as part of that, what they do is they actually release minutes of those meetings, which are up on the tax office website, and provide some very interesting reading, because essentially, while they're not law, they provide some guidance as to the current thinkings within the tax office. That doesn't mean things will change, but it certainly just gives you an indication of where they're heading. Now, of the National Tax Liaison Groups, there's a number of subcommittees or subgroups, one of those being the Superannuation Technical Subgroup. Now, back in June 2012, this group was asked the question, can you basically do a low or no interest loan to a related party using the Section 67A provisions and it not give rise to a contribution? To that answer, the tax office said yes, you can. So that of course got those in the industry rather interested, because okay, what does that really mean? So it's not a deemed contribution, but what about the other sections? Section 109, arm's length transactions. Where does it fall within Part 4A? All those sort of nice little questions that potentially can flow from that. Well, more importantly, back in December, this question was raised again, but of the actual National Tax Liaison Groups, not the technical subcommittee of super that just looks at all the super stuff, but the whole, the wider group that looks at absolutely everything. And in that, Stuart Forsyth, as being the Assistant Commissioner for Super, as well as more broadly the Tax Office, made the following assumption or statement essentially, saying the ATO's position on the low rate loan arrangements is that they do not generally invoke a contravention of SIS. They don't give rise to an arm's length income. So you may recall that if you have non-arm's length income inside a super fund, it's taxed at top marginal tax rate plus Medicare. It doesn't invoke Part 4A, and it's not considered to give rise to contributions. Now, this is a pretty great statement, really, and I suppose the thing to bear in mind is it does refer to low rate loan, not the no rate, so the zero interest. More broadly, as part of this discussion, the tax office said that Treasury is due to have a review into borrowings with inside superannuation, as proposed by the Cooper Review way back in 2010. It actually suggested that a review occur into superannuation basically after 2 years to look at all the borrowing arrangements. So not just the limited recourse borrowing arrangements we have with inside self-managed super, but more broadly instalment warrants, things like that. Now, surprise, surprise, that review hasn't occurred, and from what I understand, from speaking to Stuart Forsyth, that he is not aware of any review that is actually being undertaken by Treasury at the moment. But his comments back in December to the liaison group were that this was meant to occur, this review, and that once it does, the tax office will be making a submission on the low and no interest rate loan arrangements. So I think basically the tax office is sitting on the fence because at the moment legislatively there's not much they can do. So they will be looking for, as part of this review and borrowings, to have the legislation changed so they can essentially impose an interest rate, not unlike we have with the Division 7A requirements. Now, I've got there that, and I should just say that, and that this is taken just from one fact, saying cannot do it. There's a number of things you need to be cautious of. There actually needs to be physical cash paid. There needs to be a loan agreement in place. If the loan is from an entity, then you need to look at that entity. Is it a company? If it's a company, then you'll have deemed interest from Division 7A. If it's from a trust that has unpaid entitlements to a company, once again you'll have Div 7A apply. So it's not just a carte blanche, yes you can do it, there are some certain hurdles that you need to overcome to actually make sure it all complies and sort of works properly. Just quickly, I just want to talk about a couple of ATO prosecutions that have been kicking around because I just thought they might have been of interest. Recently, a trustee was sentenced to 6 months jail. However, he only had to serve a minimum of 14 days after he pled guilty to dishonestly contravening SIS. In this case, the trustee withdrew basically 100% of the fund's assets without satisfying a condition of release, and the money for this withdrawal was reported as a loan to associated persons, so presumably that issues BGL and the standard chart code, but there was no written agreement in place, no intention to repay, and blah blah blah. So the ATO deemed that the whole amount was an illegal access to super, and therefore the trustee should be prosecuted. Now this is interesting because previously the tax office has just gone in saying, right, non-complying, 46.5%, right, thanks for coming. But in this particular case, they've actually prosecuted, so imposed the civil penalties that they can do under SIS. And another case is actually in relation to an auditor. So basically an approved auditor was prosecuted for failing to work with the tax office by not returning phone calls or responding to the audit notification letter. So the auditor in this case failed to report a contravention of the in-house asset rules. There was a breach in there that he didn't report. He ignored phone calls from the tax office. He ignored the requests for information under a 255 notice in SIS. And basically the auditor pleaded guilty and was fined the princely sum of $1,200. But more importantly, I suppose, if he is a tax agent, this particular auditor, I'm sure the tax agent practitioners board will be looking at his membership, and not to mention that I very much doubt whether he'll actually be eligible to become a complying auditor under the new SMSF auditor registration requirements. So if all he did was audit self-managed super funds, he basically has now just lost his income and he needs to find another job. Right, so in 40 minutes, that was essentially a quick, very quick wrap-up of what's been going on inside the whole superannuation sphere of late. So now I just want to loosely touch on the proposed changes that came out on Friday last week. Now hopefully you've all received some information on that, just some I suppose more specifically the detail in relation to it all. Well, I thought I'd just quickly talk about it because that may just help sort of explain some of it as well. So essentially, out of these proposed changes, and they are exactly that, proposed changes, it is highly unlikely that they will actually be put into bills before Parliament is dissolved for the election. So, for lack of a better word, call these now election promises. The difference, though, is that by announcing it now, they can actually include it in the forward estimates for the budget, which will save the Treasurer about $1 billion over the forward estimates. So it's all about playing the forward estimates game by essentially announcing these now. Bearing in mind that there was obviously a lot of media speculation prior to these announcements, so what they've done is they've cleared that up by announcing them early, so to speak. So there were 7 proposals that were announced. I'll only talk about 3 of them, I suppose, in specific detail, however. So the first one is the cap on exempt pension income earnings. There was changes to the concessional caps, change to or reforms to the excessive contribution, concessional contribution limits, deemed rules for pensions, extending the concessional tax treatment for annuities, further lost super reforms, and the establishment of a council of the superannuation custodians. So moving on to the first 3 essentially, because at the end of the day they're the big ticket items that that most people are going to be concerned about. So exempt tax caps, what does this really mean? Well, the way that it reads, and bearing in mind that all we're working off here is press releases, so there's no legislation, there's essentially no detail behind all this, it's just a press release, or multiple press releases essentially. But basically, they've introduced a $100,000 cap per individual. So what that means is that if the intention, as far as it reads, is that if an individual inside a superannuation fund, regardless of the type, but just a superannuation fund, if an individual is on a pension and earns more than $100,000 worth of $100,000 worth of income, then anything above that $100,000 will be assessed at the normal concessional rates. So that is at 15%, or 15% or 10% depending on capital gains tax, depending if they held it for more than 12 months. So this to me begs the obvious question, what happens if you have multiple superannuation accounts? Well, that's a really good question that obviously we can't answer, because basically we don't know. The press release does quite specifically say per individual. However, under the current reporting mechanisms and the way it all sort of works at the moment, the super fund is the taxpayer. It is the one that is receiving the deduction. So to actually have this measure so it will work, they will need to increase the reporting capabilities under the current tax return for all superannuation funds, and they will need to implement a system not unlike the excessive contributions tax regime, where they'll issue a notice saying, hey, we think you've gone over, and then once you respond to that, or even if you don't respond to it, then they will assess a tax liability amount to the member. Now, presumably that actually needs to be to one of the super funds if they have multiple funds. How that works, we have no idea. Segregated assets is another interesting one. What happens if you have segregated assets within the fund, and how that's broken up? These are all detail that unfortunately I can't shed any light on because we just don't know. So there's a lot of watch this space in these announcements. Bearing in mind that these announcements will more than likely only see the light of day if the current Labor government is re-elected. Further, this cap is designed to increase by $10,000 increments, but what's interesting is that it's based on CPI. Now, most increases in the superannuation sphere is based on AWOTI, which is the average weekly ordinary time earnings. For whatever reason, for this particular measure, they've picked on CPI. And if those income rules weren't confusing enough, they now have also, as part of this measure, as a bit of a sweetener I suppose, have introduced transitional rules for capital gains tax. So essentially, if you hold an asset before 5 April 2013, you have until 1 July 2024 to sell the asset for it to be excluded from this $100,000 cap. So if, let's say that my self-managed super fund held a property and I sell that property, held a property on 1 April 2013, I sell that property on say 30 June 2020, then I will not be subject to this rule. If, however, I sold at 30 June 2025, then I would be, and the whole gain would become income. So presumably, over that 20 years, I'd like to think I'd make a little bit of a gain on my asset, and if that gain was more than $100,000, thanks for coming, I have now just paid tax on it, when if I had planned things a little bit better, I wouldn't have. So what we have now is planning for tax or capital gains tax events becomes a bit more critical. To further confuse the matter, if I had acquired the asset today and I still held it after 30 June 2014, because these measures are due to kick in from 1 July 2014, so if I held the asset from 30 June, I can essentially ignore the gain between today and 30 June 2014 if I have the asset valued as at that date. So let's say that I own a share. I'll pick on shares because that's easy. I buy it today. I pay $2 for it. If that share goes up to $10 at 30 June 2014, I now essentially have an adjusted cost base for this measure that will ignore the fact that I've made an $8 gain in that period. So if that share, if let's say I hold it for another 10 years, if that share only goes up $1, then only $1 of that capital gain that I've had throughout that whole period falls under this measure and will become part of my $100,000 cap. Any asset acquired after 1 July 2014, basically it'll be part of this measure, full stop. So really what we have now is simple super gone crazy, because we have these lovely transitional rules that apply to capital gains tax, as well as the detail that we're still waiting on as far as the individual, what constitutes an individual for the actual cap itself. So this here is, to me, an administrative nightmare that essentially all self-managed funds and all superannuation members generally, superannuants generally, will actually pay for, because the change in software that's going to be required to allow for all this, to keep track of all this, is going to be a nightmare. And to be honest, if it does come in and we don't see legislation very quickly after the election, there is no way in heck that software providers will actually be able to account for it, because there's going to be, to my way of thinking, a fundamental change that is needed to occur in a lot of different areas. So the tax office presumably are going to have to change all their software in the way that they essentially collect data, which, you know, as we all know, the ATO is a very big beast and has very big slow wheels to move. Not to mention that it does actually cost the tax office about $2 million for every tax label that they change. So it could be also a very costly exercise for the ATO to actually implement these changes as well. So fun and games. Personally, I'm hoping that the Labor government isn't elected just so we don't have to deal with this mess. Changes to the concessional contribution caps. Now, as some of you may remember, the caps are meant to be are at $25,000, and they're meant to be incrementally increased at $5,000 increments based on the awardee. Now, for 2013 and 2014, those caps have been frozen as per the last announcement in the last budget. So we still only have a cap of 25,000. If it wasn't for that, we would actually have 30,000 now. As it is, from 1 July 2014, the cap should be $30,000 for that 2015 financial year. But what they've done is they've sort of met halfway in relation to the caps, because you may recall that it was $50,000 for members over 50. Well, what they're doing is that basically if you have someone who's over age 60 as of 1 July this year, they will now have a cap of $35,000. After 1 July 2014, if the member is age over 50, then their cap will then be $35,000 rather than rather than $30,000. So now we have, I suppose, more scales to what we have. But more interestingly, the cap, when it reaches $35,000, which is expected to be at 2018, I will say expected, the provision does not allow for indexation beyond that. So basically, we'll have in 2015, the cap should be 30,000, and then after 2015, which I think it will be 2018 or 2019, the cap should reach $35,000. Then essentially it will stay there. So then we will once again have the discussion as to what this means as far as future contributions and indexation. Bearing in mind too, there's been no discussion about how this will actually work from the non-concessional point of view, because the non-concessional cap is actually a factor or a formula based on the concessional cap being 6 times. So presumably this means that for people over age 60, their non-concessional caps will also increase. So basically their non-concessional contributions will increase to $210,000 from 1 July 2013. Once again, we have no detail, and once again, we're not likely to actually see any detail before the election. So this is one of those lovely little planning measures that you can't actually plan for after this commencement date, because we don't actually know if it will apply or not, because if they don't get elected, then you can't use it. And then finally, I just want to quickly touch on the reforms for the excessive contributions, concessional contributions tax treatment. Now, importantly, this only relates to the concessional contributions, not the non-concessional excessive amounts. So you might remember that back in 27 June 2012, the government introduced via legislation the ability to have a $10,000 one-time only free set of steak knives ability to refund an excessive contribution. So if you had an excessive amount of $5, then that was your one-time opportunity to use that. If you didn't use it, then you lose the whole thing. So they've changed this measure again, not even 12 months later, to basically remove that $10,000 threshold. So now we will have the situation where any excessive amount from 1 July 2013 can be refunded back to the member and treated as part of their normal contributions tax. Part of their normal marginal tax rate. One thing that is a little bit different is that there's also interest, deemed interest, that will apply to these amounts, where previously that hasn't applied. So the big tickets from this measure, or proposed measure, is that not only is that the $10,000 cap is gone, or the threshold is gone, but also you can use it, it appears that we'll be able to use it multiple times. So let's say, for argument's sake, if you have a client that is a locum GP that has 3 employers and they all pay in excess of $25,000 concessional contributions, then essentially he will be able to use this measure year on year, so he doesn't have to pay excessive tax within inside his super fund. It just means that he pays tax personally. At the end of the day, it's going to be the same net result, because someone who's having, in that situation, they're going to be on top marginal tax rate anyway, so they're going to pay top marginal tax whether it be inside the fund or be it personally. It's only those situations where someone is on a low income and they salary sacrifice into super that this measure becomes quite attractive for. And essentially, that is all I wanted to cover off on this afternoon. So unless there is any questions, which I'm more than glad to take now, or if you would like to email me through or to Deirdre later on, by all means, please feel free to do so. It certainly has been a busy few months with Inside Superannuation without the proposed changes, and I'm sure that we're likely to see a lot more in the coming 3 months, the way things are going. So if there's no further questions, then I might wrap it up. There you go, a couple of minutes early. So I'd like to thank you all for your attendance, and I look forward to talking to you again in, I think it's early July that we'll be having one. Actually, sorry, I forgot, we'll be doing a budget webinar on the 15th of May, so look out for that one. It's a bit of a budget update. Hopefully all my stuff's now covered, so it'll all become essentially Kim's work to do for the budget, which is nice for a change. Otherwise, the next super webinar update will be in early July. So if there's no further questions, I look forward to talking to you all then, and we'll talk soon. All right, thank you. Bye-bye.